Welcome to Wealthfinity, where we help you navigate the world of investing and personal finance. In this channel, we'll be exploring the differences between two popular mutual funds, VTSAX and VFIAX, and how to master investing in them. Whether you're a seasoned investor or just starting out, understanding the pros and cons of these funds can help you make informed investment decisions and achieve your financial goals. Join us as we dive into the world of VTSAX and VFIAX and learn how to maximize your returns. When it comes to investing in the stock market, there are a lot of options available. Two popular choices are VTSAX and VFIAX, both of which are index funds managed by Vanguard. But which one is better? VTSAX, or the Vanguard Total Stock Market Index Fund, tracks the performance of the entire U.S. stock market, including large, mid, and small cap stocks. VFIAX, or the Vanguard 500 Index Fund, tracks the performance of the S&P 500, which includes only large cap stocks. One advantage of investing in VTSAX is that it provides exposure to a wider range of companies and sectors. This can be beneficial for diversification purposes, as it spreads out your investments across many different industries. Additionally, VTSAX has historically had slightly higher returns than VFIAX over the long term. On the other hand, VFIAX has some advantages as well. The S&P 500 is a well-known and widely followed index, which means it can be easier to track and understand for new investors. VFIAX also has a lower expense ratio than VTSAX, which means that you will pay less in fees to invest in the fund. Ultimately, the decision of which fund to invest in depends on your personal investment goals and preferences. If you value diversification and potentially higher returns over the long term, VTSAX may be the better choice for you. If you prefer a simpler investment strategy with lower fees and a focus on large cap stocks, VFIAX may be a better fit. Investing in the stock market can be an excellent way to build wealth over the long term. Two popular investment options for those looking to invest in the U.S. stock market are VTSAX and VFIAX. Both funds are offered by Vanguard and are well regarded by investors. In this video, we'll take a closer look at VTSAX versus VFIAX to help you make an informed decision on which one is right for you. What are VTSAX and VFIAX? VTSAX and VFIAX are both mutual funds that track different stock market indices. VTSAX tracks the CRSP US Total Market Index, which includes nearly all U.S. stocks, while VFIAX tracks the S&P 500, which is a subset of the U.S. stock market that includes the 500 largest companies. VTSAX holds over 3,600 stocks, while VFIAX holds around 500. Performance. Historically, the stock market has offered higher returns than other types of investments, such as bonds and cash. Over the long term, VTSAX and VFIAX have both performed well, but their returns have not been identical. According to Morningstar, over the past decade, VTSAX has had an average annual return of 14.68%, while VFIAX has had an average annual return of 15.13%. While the difference in returns may seem small, it can compound over time and make a significant difference in your investment results. Diversification. One of the main advantages of VTSAX over VFIAX is that it provides broader diversification. As it tracks the entire U.S. stock market, VTSAX includes small cap and mid cap stocks, in addition to large cap stocks that are included in VFIAX. This diversification can help reduce risk, as it ensures that your investments are spread across many different companies and industries. Expense ratio. When it comes to mutual funds, expense ratios can have a significant impact on your investment returns over time. The expense ratio is the percentage of your investment that goes towards the fund's operating expenses. VTSAX has an expense ratio of 0.04%, while VFIAX has an expense ratio of 0.04%. This means that for every $10,000 invested, VTSAX charges $4 in fees, while VFIAX charges $4. Both funds have some of the lowest expense ratios available, making them an excellent option for cost-conscious investors. Minimum investment. Another factor to consider when deciding between VTSAX and VFIAX is the minimum investment required. VTSAX has a minimum initial investment of $3,000, while VFIAX has a minimum initial investment of $3,000. This means that if you have less than $3,000 to invest, you will not be able to invest in either fund directly. However, both funds offer ETF versions, which have lower minimum investments and trade like stocks. Additionally, investors may also want to consider the tax implications of investing in VTSAX versus VFIAX. Both funds are tax efficient, as they have low turnover rates, which means they don't buy and sell stocks frequently, leading to fewer taxable events. However, VTSAX may be more tax efficient than VFIAX due to its broader diversification. By holding a larger number of stocks, VTSAX may be better equipped to offset any losses from underperforming stocks with gains from outperforming stocks, potentially reducing taxable gains. VTSAX and VFIAX are both excellent options for investors looking to invest in the U.S. stock market. VTSAX provides broader diversification, while VFIAX is more concentrated in large-cap stocks. Both funds have performed well historically and have low expense ratios, making them an attractive option for cost-conscious investors. When choosing between the two, it ultimately comes down to personal preference and investment goals. If you're looking for broad diversification across the entire U.S. stock market, VTSAX may be the better option. However, if you want to focus on the largest U.S. companies, VFIAX may be a better fit. In conclusion, the comparison between VTSAX and VFIAX presented in the video highlights the differences between investing in a total stock market index fund versus a large cap index fund. While both funds offer benefits and drawbacks, ultimately, the choice between them depends on an investor's goals, risk tolerance, and portfolio diversification strategy. It is important to do thorough research and consult with a financial advisor before making any investment decisions. Additionally, investors should remember to stay disciplined, patient, and focused on the long term when investing in the stock market.